Welcome to everyone just joining us now in our webinar for all about US investing. We'll just give it a minute for everyone to come in and then we will kick off with some great content. I'm sure we'll all learn a lot together today about some of the trends happening in the US market and what opportunities it offers us as investors. While everyone's coming into the webinar, you can feel free to say hi in the chat, let us know where you're joining in from and what you're up to on this Wednesday. I'm sure a lot of you are at work, so for those that are, thank you for joining us on your lunch break. But yeah, it'd be great to hear where you're coming from. And then we will kick it off. All right, so welcome everyone to our Reasons to Invest in the US webinar. Today I am very honoured to welcome Danielle Ecuyer, hope I got that right, to join us and talk more about the US market in particular. Danielle has written 2 books, the latest of which is Shareplicity 2, which we will talk a little bit more about at the end, but it's really giving people that simple guide to investing, and we're really honoured to have her here with us today. I will just go through a little bit of housekeeping before we get started. So you've got the Q&A function. For those of you who have joined our webinars before, you'll know that we always have time for Q&A at the end of the webinar. So throughout, please feel free to put your questions in the Q&A, that you can use the chat function there for any general commentary or chat throughout the webinar, and then the Q&A function specifically for questions. Now I'll just share my screen and we'll present our slides for today. Now, Superhero and Shareplicity do not provide financial advice that considers your personal objectives, financial situation, or particular needs, and all investments carry risks, so please consider carefully before investing. Past performance is not indicative of future performance, and the pictures, graphics, and charts you see today are provided for illustrative purposes only. We will be showing some historical charts. Just keep in mind that is past performance. And before we get into the content, Danny, I would love to hear, and I'm sure our audience would love to hear a little bit more about you, your journey with investing, and also your career and what brought you to writing these books all about Shareplicity and simple investing.
Thank you so much, Rachel. Hi, everyone. This is great to, well, e-Zoom you, so to speak. Anyway, basically, I've been involved in share investing since I left university. I started in 1986. A lot of you probably weren't even born. And I trained as a share equities analyst, which basically meant I analyzed companies. I did all that exciting stuff like analyzing balance sheets, profit and loss, cash flow. And I got the really sexy sectors of building materials and transport here in Australia. I then moved to London because I felt I wanted to expand my career. And there I moved on to what's called institutional equity sales, which in simplistic terms is basically advising your superannuation funds, unit trusts, management investment vehicles out of in the UK. And I moved to a very famous firm called Baring Securities, which went spectacularly bust with Nick Leeson towards the latter part of the 90s. And I specialized in emerging markets. And they were very exciting times. And I was very privileged and honored to work in one of the best firms in the world, in some of the most exciting share markets, and also some of the largest clients in the world. And since then, I did a stint in wealth management, which really wasn't for me, but from an investing perspective, it was very interesting. But when I moved back to Australia in 2003 with a young son, when I got divorced, I then decided to turn my back on that career for numerous personal reasons, and I started investing myself at the start pretty much of the GFC in 2008. And all of this has culminated over 3 decades of investing experience, both as a professional and as a private person, culminated in Shareplicity, a simple approach to share investing, which was released yay, at the start of lockdowns last year. And the second book I wrote, Shareplicity 2, A Guide to Investing in US Stock Markets, came out, dare I say, at the start of this other lockdown. So I actually haven't seen the book in the bookshop yet. So I'm just going to give everybody a warning now. If I'm writing a third book, I will let you know and prepare.
That's great. Thank you so much, Danny. And I can't wait to hear more from you, both from your personal and your professional experience. Today, we are going to focus on the US market. Superhero, we launched US trading in July, and are just starting to see more and more people than ever invest in the US market. But I think for a lot of people, there is quite a lot of unknowns still, or questions they have about the difficulty, maybe some of the risks, but also the opportunity that the US market presents. And so we'll go through some of that today, kind of the US markets now, in the future, some of the key trends that we're seeing in the market, and then how does someone actually invest in the US market. So I'll hand it over to you just to start us off with some of the historical trends that we've seen in the US markets.
Absolutely. This is just what I call the macroeconomic overview. So for those of you that either understand or those of you a bit newer, people analyze share markets from two perspectives, and one is called the macroeconomic, the big picture, and the other way is doing stock selection. So I just wanted to give a really, really quick overview, so to set the stage where we are in the world, in the US stock markets. And these two charts basically show that inflation and interest rates have been trending down since the beginning of the 1980s. And the reason why that is so significant is that interest rates have been the tool of choice by central banks. It's the Reserve Bank in Australia, it's the Federal Reserve in the US, have been the tool of choice to ensure that economic growth has continued over the last 4 decades. And if we have a look there, that you can see at the same time as inflation, the chart on the right, which is marked by the US 10-year Treasury bond, which is, excuse me, like a global benchmark for interest rates. As that has come down, inflation has also come down. And over this time frame, the grey lines are the recessions. You can see that the central banks have responded to a recession by lowering rates. And all of you would have been aware that last year in the coronavirus stock market crash, where we had that really swift 36% sell-off in markets, you saw the Reserve Bank as well as the Federal Reserve come basically to the rescue of markets and also to our economies by dropping rates very low. Why is this important? It has basically meant that for a lot of people, myself included, that putting your savings in a bank deposit does not yield very much. And if I could tell you, going back to the late 1970s, early 80s, when I was young, my mother used to put her cash on deposit overnight in a cash management account and earn about 14% interest. So it's very hard, I'm sure, for all of you to imagine how much times have changed. So let's move on to the next slides, Rachel. And yeah, so why these two slides, again, just setting the stage for you. So the one on the left-hand side is actually from a former colleague of mine who used to run the global equity strategy research for Baring Securities. He's been around longer than myself in equity markets, and he does what's called global financial analysis. And the chart on the left, why I just wanted to show everybody, is that over this time frame since the 1980s, as interest rates have come down and stock markets and asset markets have gone up, basically global financial assets are a larger portion of our economy. And I guess why that is important is that it really means that going forward, it's hard to envisage that we are at any time soon going back to even interest rates at 4%, because at the moment there's a lot of debate about where interest rates are going. And then the chart on the right, although this is a log scale and really doesn't show the full extent of how the S&P 500, okay, so this represents the largest 500 companies in the US stock markets by market capitalization. It has basically been trending up over time. And probably more importantly is the move from 1980, when you actually saw those interest rates going down.
Yeah, thanks, Danny. So I guess the slide before and this slide, they really are almost the inverse of each other, right? So as inflation and kind of those monetary policies were put in place to start to grow the economy, I guess we can really see that in the fact that the share market or companies have grown quite a lot. Therefore, the share market and the global financial asset pool has grown as a result of that, that policy being put in place.
Yeah, absolutely. And I actually learned the other day that in 1980, because companies typically are valued on what is called a PE multiple, a price to earnings ratio, and you can look up what it is, or you can read up on it if you don't know what it is. But basically, it's a valuation tool for the share market. And if you can imagine that if 0 is low and 100 is high, as in expensive, in the early 1980s, the PER for the S&P 500 was 3 times. That's forward-looking earnings, not historic. And now it is currently around 22, 23 times. So what that is telling you is that not only have companies grown earnings over this time, but also valuations have increased. And as Rachel rightly pointed out, the reason for that is because interest rates have moved down. You know, it doesn't mean, when I'm saying all of this, that the party is over. And I think that's what is really an important takeaway, is that for the period going forward, we are almost in a situation of what's called the TINA trade. There is no alternative, which basically means people will continue to be looking for returns out of assets like the stock market.
Yeah, thanks, Danny. And I mean, it's always of interest to me how the difference between property and shares moves as well. And as property prices get more expensive than ever, people are looking for multiple ways to grow their wealth, not just traditional ways either.
Absolutely. And as we will discover as we go through this, the stock market, particularly the US stock markets, have so many exciting things on offer.
Absolutely. So talking about exciting things on offer, let's talk about some of the mega trends and really mega companies that we've seen emerge over the last 20, 30 years, with obviously the focus on the US.
Absolutely. And I always say to people, the one reason why I wanted to invest in the US, which I started in around 2016, is for innovation and technology. The Australian stock market is traditionally a very cyclical market. It's very much based on the housing sector and also the mining sector. The US, however, as you all know, I don't need to tell you guys, we all have our, smartphones. We're either Apple aficionados or not, but we basically are exposed to all these amazing new companies that have been making people a lot of money over the years. And there is very good reason why these companies will continue to do well. So what I did when I was looking at the US stock markets was trying to break down what I call these secular megatrends. And a secular megatrend is basically, it means that a specific sector in an economy is going to grow outside of the normal economic cycles that economies have. And I tried to isolate some of these for you today, put them into different categories. The first one that we want to touch on is the ongoing effects of digitalisation. It's been very much accelerated throughout the pandemic. It has brought earnings forward, but the more I listen to experts, not only on the way we're working toward, let's say, hybrid working models and the changes that we've all adapted to during this pandemic period, is that digitalization is not going away anytime soon. And for example, you just have to ask, let's say my son, he never switches on the television, obvious reasons. He watches YouTubes, he watches streaming, he shops online. He actually doesn't even like going to a shopping mall. And I've tried to break down run some of these examples for you, but in the e-commerce space, obviously the big one that changed everything was Amazon, but you've got a whole lot of others in terms of you've got Etsy, you've got eBay, you've got Shopify, which crosses across a few sectors. And those digital marketplaces, digital entertainment, again, I don't need to tell you about Netflix, Disney Plus, and it's also expanded into the likes of the healthcare system. And in Australia, we actually have a very good company called ResMed, but in the US, it's Teladoc. And I think you can continue to see more expansion there. So you cluster all that together and it's basically digitalization, e-commerce. Now, if we look at what flows off of that sector, we move to things such as cloud computing and cybersecurity. So in order to facilitate all these changes, we basically need the cloud. And the cloud, as everybody knows, is massive big data centers, and they facilitate the storage of data and information. The three big players in there are Amazon, Microsoft, and Google, although Oracle apparently is making a push into this area, but they are very much the leaders. And to give you an idea, I think in the book I cite that we think that it's developed so much, but we're really only the tip of the iceberg in terms of how much more companies are going to move towards the cloud. And of course, we've all noticed in this period of lockdowns, pandemic, we now need more cybersecurity. And in fact, this morning on the radio, I heard the ABC talking about how vulnerable everybody is and how much more cybersecurity we need. So again, that is another big trend that all comes about through cloud computing, through e-commerce, through digitalization. The other one that I'm really positive on is obviously enterprise software companies. In fact, Rachel and I have been discussing Slack just beforehand, and I do think that the younger you are and the more you are exposed to different software products, the better your understanding of the product that you are actually using. And for me, I've always had Microsoft for years and years and years, but clearly there are a lot of great companies in that space. And the other one that facilitates all of this and is almost the backbone of everything is the semiconductor chip space. And NVIDIA and AMD are the new kids on the block, and companies like Broadcom, Intel are the older ones. But the real elephant in the room, and I'm slightly racing through this because there's kind of a lot here. Well, there's two elephants. One is the fintech space. Again, I don't need to tell everybody about Afterpay, Square buying Afterpay. PayPal's also moving into buy now, pay later. You've seen Amazon moving in with Affirm, which is a US equivalent of a Afterpay. But there's so much to be evolved in the digital wallet. Everything's continuing to move online. But my favorite of all favorite sectors, if I have to have one, is actually decarbonisation and clean energy. This is the one that is actually going to see the most money being committed to decarbonise the globe. And there are some very exciting companies in there. And if anyone has ever Googled me, I am a diehard Tesla fan. I'm not telling you all to go and buy the stock, but I think it is actually a seminal moment in time where this company is actually changing the dynamics of not only energy, but also transportation. So one of the big reasons that I still think everybody should have exposure or look at the US markets is all of these megatrends. They're much harder to capture in the Australian stock market in terms of stocks individually than actually the US.
Yeah, thanks so much, Danny. And I think sometimes, and this is probably a question again back to you, when people think about the US market, it can have a perception of more risky. And yeah, what do you think about that in terms of people's perception of the US market being this big behemoth that we don't really understand, versus I guess what you've shown us and what we've really seen is we know these brands. We use these brands every day. We use these products, whether it be in our personal life or our work life. And maybe the US market isn't so far away and hard to understand as we think. What would you say to that?
Totally. I think in many respects, it's a lot easier to understand a company like Apple, for example, or Google, than actually understanding a lithium miner here in Australia or a gold miner, because you have to understand not only the cycles of the commodity prices involved, but you also have to understand costs of production and where the mine's located. Is there geopolitical risk? I think the thing is that investors, and it's not only in Australia, it happens in the US, it happens everywhere. People tend to like to focus on what's near and close to them. But that's just like kind of a fear factor and a comfort. But at the end of the day, these are the largest stock markets, okay, that I'm talking about the New York Stock Exchange and NASDAQ combined, $33 trillion. They are the largest in the world. The US financial system pretty much sets the interest rates policy pretty much for the rest of the globe. And you have to understand that if any market is the safest market in the world, it is actually the US and the US dollar. And the reason is because, as someone says, if you worry about the US, then we've probably got other bigger problems to worry about. And I think that, like anything in life, some diversification to your share portfolio is really important. That's the first thing. And the second thing is that these are companies that you can understand. It's no longer the case that once upon a time, to understand what Walmart did, you really have to just kind of make it up in your head. It's not a case that you have to walk into a Walmart, which is like, walking into Coles or Woolies, or what's more a combined, shop of everything. You don't have to do that. You are basically interfacing with all this technology in innovation and companies most days of your life. And I think that's really where the younger generation have an edge over the older generation, which is stuck in a paradigm of investing for dividends solely and franking credits and more traditional companies.
Yeah, absolutely. And the younger generation definitely are some of the early adopters of a lot of these new technologies and brands that pop up. And so that equally, as it can be an opportunity for what we use as customers, it can also be an opportunity when it comes to investing and actually owning a share in that company's growth.
Absolutely. And I also think that it may sound fanciful or it may sound idealistic, but I am a great believer as you can invest to see the change that you want to see in the world. And that leads on to the whole concept of the growth in environmental social governance investing.
Yeah, absolutely. So we have kind of covered this space, but Danny, this slide just does tell us a little bit more about growth in sectors. Could you take us through what this one means?
Yeah, I actually got this slide, and it was used in a piece, or the basis of it was used in a piece for the Australian. And the reason was to actually show people that you have actually seen information technologies sectors, companies evolve. So we're no longer back in the dot-com bubble era where there was so much excitement. Everybody wanted to create an e-commerce company and go onto the internet. And a lot of those companies really didn't have anything behind them. And the importance of this chart, it actually shows you that the growth in dividends from technology companies has grown substantially and is now one of the largest contributing factors to the dividend for the S&P 500, which is a larger index of companies. And it's moved beyond financials, materials, so commodity stocks, and even healthcare. And why that's significant is I think it shows you that not only are the companies far more solid, they have massive cash flows, really strong balance sheets, and they're actually returning money to investors, which makes them a less volatile investment, i.e. they don't go up like that and they don't collapse as much over time in general.
Yeah, sure, which is, I think sometimes people almost bucket tech or information technology into the growth stock kind of sector, as opposed to more of a safe dividend stock, but it is showing the maturity of some of these tech companies as they grow, as they become really pillars of the stock market and of our world, that they do transition into that giving value back to shareholders.
Absolutely. And that's
there
really
can be
important.
growth in income.
Yeah, it's really important because the funny thing is, as I was listening this morning, because obviously Apple had its day announcing the new iPhone 13, and a whole lot of the Wall Street commentators on CNBC are like, oh, yawn, the company's had it boring. Oh, gosh, I'm just going to go and buy a whole lot of different cryptocurrencies. Well, of course, that kind of puts the fear of, whatever into me going, well, this is a company that has a $2.6 trillion valuation that has so much cash on its balance sheet. It's probably, now I'm not telling everybody to go and buy Apple, I'm just trying to make a point. It's not a narrative or a belief that you're going to double your money overnight, like with a crypto, which it's certainly, to me, some cryptos is more like probably going to the horse races. These are incredibly strong companies that I think have proven themselves time and again.
Absolutely. I mean, Apple, the valuation of Apple is, and again, not saying that Apple's the stock you should go and buy, but the valuation of Apple as one company is bigger than the entire ASX. So that gives you a bit of a comparison as to the sheer size of some of these companies over in the US.
This was one that we actually just did just to show one of the reasons why, apart from technology, innovation, diversification of buying into the US stock markets, you have basically made more money over there. And predominantly, I just picked out, so you've got Apple, BHP, Microsoft, and CBA. So I've kind of picked the biggest stocks in both markets. And as the chart will show you, going back to 2017, the total return, and it's really important because Australia has such a high payout ratio for dividends, is the total return has been superior in the likes of Apple and Microsoft. And I do know that there has been a catch cry. You can't buy a stock because look how much it's gone up, or you can't buy a stock because it's gone X growth. Two things: when I first bought Amazon, it was around $600 in 2016. And whilst the share hasn't done much in the last year, it's hovering around $3,400. So it was actually the right thing to do. The second thing is that these companies, even if they did hit what's called antitrust legislation, which is a pushback from the government that they're getting too strong, you could argue that some of them will be worth more if the parts were broken up, because businesses such as the cloud computing businesses are incredibly valuable and still growing really, really strongly. And I think that's what everybody has to understand, that so many of these trends that these companies are involved in are really just going to continue to accelerate over time. And companies, particularly in tough economic times, will be looking to cut costs, improve efficiencies, improve productivity. And that really, technology is the way that can lead to solving those problems.
Yeah, a really interesting point that you mentioned there, Danny. I mean, you used Amazon as the example there. What is really beneath the hood of a lot of these companies? We might know Amazon as a consumer, as the e-commerce platform where you buy things that get delivered to your house, but Amazon have a huge business in the cloud computing space. And that has seen a lot of growth in the last couple of years as well. And a lot of these companies, because they are so big, they have already seen so much innovation. I guess they're also in a good position to see new opportunities and move into areas where they haven't before, or add new business units. So it's always important to look beyond the brand logo as well into the multiple different types of businesses or revenue streams that a company might have, and ways that they're innovating.
Yeah, and as I said, it's almost like the more of the digitalization of the globe occurs, the more there is data analytics, machine learning, or what is termed sometimes AI, cybersecurity. I mean, all of these companies pretty much have a finger in all of these pies and will continue to grow in that direction. And I think that, it sounds like we're just pushing kind of FANG stocks at the moment, and the US is so much more than that. But when we move on further down the track, which is probably a good point to lead to, is that you can see that there are ways to actually capture different baskets. So let's move on to how you can invest in US shares. And it's really quite simple. You can buy the shares directly. And I think, Rachel, you're going to explain a little bit more about that for the listeners. Or alternatively, you can buy the flavor of the decade, which is still growing, which is exchange traded funds, which are listed in both the Australian market and the US market. And the thing about exchange traded funds and why they can work quite well in a portfolio is that you capture a group of stocks. So it's like, instead of just buying a Snickers bar, you are obviously buying a whole group of, Snickers and Mars bars, Cherry Ripes, etc., all at once. And the point is that one financial listed product, an ETF, can give you exposure to either a whole lot of companies in an index like NASDAQ or the S&P 500, or it can give you exposure to those secular megatrends. And I often say, ultimately, you want to own the winning companies in any specific sector. You want to own the ones that are at the top of the pyramid, because they're the ones that have the pricing power, they have the competitive advantage. But sometimes with these emerging secular trends, it's really hard to pick who the winner is going to be. So rather than trying to pick the winner, the best way to do it is to actually look at an ETF product, because they will scoop up a whole group of them. And by definition, normally they're weighted by an index. The best companies will rise to the top, and that will drag the value of the ETF higher over time.
Yeah, absolutely. And Danny, we're going to go through this now, but it really does come back to who you are as an individual as well, what risk you're willing to take, and how much time and effort you want to spend in creating that portfolio as to the balance of what you choose.
Totally. And this is really important because, as I think I have shown myself over time, investing is kind of like a journey. And it's also a journey about getting to know yourself, what you're comfortable with, your risk parameters. And it's very much the case that unless you actually become involved, you won't actually learn. It's a bit like any sport. Really good athletes make the sport look very easy. So in this portfolio allocation in both books, I kind of like to give people some benchmarks or examples of how you can run a portfolio. And basically, I have what's called low, medium, and high maintenance. And everybody is going to choose a different pathway. And how I determine how much maintenance or how much involvement you have in your portfolio is largely determined how you asset allocate, either just to ETFs or whether you allocate to ETFs and stocks. And obviously, at one end of the spectrum, the ETFs are the least low maintenance. You basically, I've given an example here, you can have 10 ETFs, a 10% weighting each. And let's just say that over time, you continue to drip feed money into those ETFs, and you're probably all aware the benefits of dollar cost averaging over time, because you take out the cyclical and volatile movements in the share price. And then I say, well, look, let's say you're starting to get the bug about investing and you're really enjoying it, and you like to look up about companies, you're learning a bit more. You can actually, I always say, it's like the ETFs are the backbone of the portfolio, and then you start to add what I call the ribs, which are basically the shares, the stocks. And they're the ones that hopefully give you higher returns than just the ETF. And so an example here is that you can have 5 ETFs and 10 stocks, and you lower the weighting to about 5%. And then obviously the other ones, you start to the high maintenance, you cut the amount of ETFs and you add more stocks. And the really important lesson for everyone to understand is, if you have what's called a concentrated portfolio, which is a small amount of stocks with a high weighting, you may make a lot of money, but you also may be risking taking some losses. So generally speaking, I don't tend to run very high concentration portfolios, partly because it's my age and I'm also in a capital preservation stage. There's not large amounts of income coming in. When you are younger, you can take bigger bets on companies, for example. So typically speaking, I have about 5 to 6% of my money in any one share, but you can have it as high as 10%. Just as a rule of thumb, if you want to just have 1 or 2, you're obviously taking a much higher level of risk. But there's all different ways to mix and match your portfolios. for the US, and it can be done either via Australian or US ETFs.
Thanks so much for that, Danny. So you mentioned, actually, before we get into, I will take everyone through just how to buy either Aussie ETFs that have US shares in them or US shares directly. But before we do move into that, let's just recap a few of the points that you've taken us through, and then we'll move into, so how do I actually do this? And then we'll have some time for questions if anyone's got questions.
Yeah, sure. So again, it's really funny because I used to do emerging markets, and I'm sure you've heard people say, buy emerging markets, they're fabulous, they're going to give you lots of growth. They've been emerging for quite a long while. And you may have heard also in the media about China and some of the problems there with Xi Jinping cracking down. I guess one of the biggest reasons why you want to invest in America, that it's highly well regulated, it's incredibly liquid, meaning you can buy and sell very easily. It's the largest in the world, and it gives you that most amazing exposure to this technology and secular megatrends. And I'm currently just writing a little blog post about this, because I continue, no matter how much we've got some inflation problems starting to appear, I really do see that the world has changed irrevocably because of the pandemic, and that we're going to continue to see this innovation that will disrupt businesses. And the US, again, is really a leader in so many technologies. The thing I love the most, why the younger generation is so lucky, is that once upon a time, I always say you had to be Jamie Packer or Kerry Packer to be able to afford to invest overseas, because you had to have a stockbroker. There were very large fees. Now we can all, which is a good and a bad thing, we can all sit on our phones on a fabulous app like Superhero and actually invest into the US. And I think that's something that's pretty amazing. It's kind of what has been termed the democratization of investing. And the other point is that once upon a time, information about investing in stocks was very much guarded by the stockbrokers, kept for their clients who were typically more affluent. Nowadays, you are so lucky. There is so much information out there that you can actually read about companies, get expert opinions, and the digitalization of the world has opened up, whether it's YouTube platforms or the Twitter platforms. It doesn't mean that you don't need to do your research. You do, but it is just so much easier. And I think that's a really positive thing. And why I wrote the second book was actually to share with everybody a passion that I believe that there is a lot still to be had from investing in US stock markets.
Absolutely. I think it's so great that there is really that equality and access to information, both I guess information about stocks, but then also how to, and actually going forward and actually making that investment than there ever has been before. So before we go into question time, I did just want to take everyone through, I think most of you have a Superhero account, but if you haven't traded US shares with us before, just take you through how that works. So Danny, we spoke about the fact that people can get exposure to the US market through Australian ETFs. So I guess on Superhero, that's super simple. Sorry, my AirPod's falling out. You can deposit $100 and you can buy an Australian ETF. And that is a great way if you don't want to go directly into the US. But like we did mention, with an ETF, it's a group of stocks. So you can't individually invest in one company in the US through the Australian share market. So when we launched our US share trading offering, it was very much to enable that access and allow people to invest directly into companies that they were passionate about or that they believed have that growth for the future. So to do that, it's pretty simple. It all happens in a very similar way to our Aussie investing, but you would log into your Superhero account. You'll go to your Superhero wallet, and now there's two tabs here. Your AUD tab, which you can see on the second image there, that is where you deposit from your bank account into Australian dollars. And then the second tab, which is USD, is where you can transfer between Aussie and US dollars. in real time there, and it all does it for you in Superhero. So you do need to transfer to US dollars in order to invest in a US share. But when you are ready to invest, you'll be able to see how many Aussie dollars you have and how many US dollars you have once you've done that transfer. And then you can see Aussie and US stocks side by side. You can see there a little filter. So if you just want to look at American stocks, you can do that. And then you go away and place your order the same way that you would an Australian share. So the only real difference or extra step, if you've invested in Aussie shares and you want to go into US direct shares, is that transfer from Aussie dollars to US dollars. And that happens in real time on Superhero. You will be charged a small FX fee, which you'll be able to see on that third image. We tell you that up front, how much that's going to be. But once you've transferred to US dollars, there's zero brokerage on trade. So you can buy and sell shares and you won't be charged any other fees apart from that FX fee when you transfer between Australian and US dollars. So you can trade for zero brokerage, just the fee on that FX or currency transfer. Danny, this is going back or a side note a little bit, but I did just want to get your expert knowledge on this. There is often a question that people have around currencies. And the difference between investing in Australia and the US when it comes to transferring currencies, I guess the benefits and or potential risks of that. What would you say to people who are wondering how transferring between currency might affect their investments?
Yeah, well, one of the reasons why you invest overseas is for diversification. And to give you an example, it's with a domestic currency, you're exposed to, let's say, something happening to the country, and you don't want to have potentially all your money just in Australian dollars. And over time, look, basically, I don't hedge my US dollars. And I was listening to a real expert, a big fund manager who has a few billion under management, who actually invests globally in quality companies, particularly in the US. And they don't hedge the currency either. Over time, the Aussie dollar really has remained relatively stable relative to the US dollar, kind of floating between sort of 70, 80 US dollars cents. And I think the thing is that your primary reason is to invest for the growth. And I do believe that the growth will more than offset potentially any currency movements. The real question everybody has to ask themselves is, am I investing really short term, or am I going to put away these shares for a 5 to 10 year period? And the basics of share investing is that it's time in the market, not timing the market. And it's staying in the markets for a prolonged period of time. And I have had the view that I just don't want to own Australian shares going into my latter years. I want some US shares to give me that diversity. And as far as I'm concerned, if I invest appropriately, that dividend income from the US will grow sufficiently. And the impact of Aussie dollar movements, it can go either way, but it's not the primary concern, basically. I don't think you're going to see the Aussie dollar going to 120 US cents. Let's put it that way. But I hope I don't have to eat my words.
Thanks, Danny. That's great. I think we've got one more slide, and that is just to tell people a little bit more about Shareplicity, and then we will go into that Q&A. I can see a few questions coming through. Shareplicity 2, Danny, is your new book all about investing in the US market. I've actually started to read it. I was very lucky to be given a copy. But yeah, tell us a little bit more about Shareplicity 2. And I think we've got a slide where people can find it if they do want to know more about US investing.
Yeah, so basically, I start with a really fun chapter. I think you can actually download the first chapter for free at my website, shareplicity.com.au, and that'll give you an idea of what the book is about. It's really a guide to explain to you how on earth do you look at this massive elephant in the room. And It is an elephant, but it's a very exciting elephant. And what the book does is basically breaks it down into bite-sized pieces so you can understand which ways that you want to invest and which stocks or sectors you want to invest in. And it also basically explains how valuations work, which I think is really important. And all the while, I've kept it to be, as I was very proud, Claude Walker has just given the book a fabulous review. Claude Walker is from A Rich Life. He is on Ausbiz. And he said it was kind of like sitting down in the living room and Danielle is explaining either to her young self or to her mother how to invest. And I think that's really important because unless I could achieve that, no one would understand it. So it is to take you through all the different machinations. You don't have to read the chapters sequentially. You can kind of dip in and dip out. And it also gives lots of examples of ETFs, both in the US and in Australia. But just bear in mind that the pool of ETFs is currently continuing to grow quite rapidly.
Great, thank you for that. And if people are interested, they can go online to a number of online bookstores as well, and you can search Shareplicity too, and you'll be able to find it hopefully in person as well once lockdown opens up. And Danny's kindly offered us a code, so I will also send that code around to everyone that's joined via email. You get a Zoom email with the recording and that code as well. Thank you very much to Danny for offering that to us today. Now I'll stop sharing my screen and we'll go through a few of these questions, Danny. I think we've got a few minutes.
Yeah, sure.
So bear with me.
Yep.
So that's a good question. I'm not sure whether you know this one, Danny, but does an Australian ETF for the US market, so an ASX ETF that holds US stocks, does the pricing happen during the US hours when the share prices are moved, or does it happen during the Australian time zone for people?
I'm pretty sure the market makers that do the ETFs would actually do it at the close of the US market prior to our market opening up. But it's a bit of a technical question and something that you probably should ask Beta Shares or Vanguard at the end of the day, because they all probably may vary in terms of how they actually do their NAV. But again, I think you will see an adjustment quite quickly in the bid offer spread on an ETF to reflect the change in the NAV on the stocks that are held.
Yeah, sure. The ETF providers' websites are a great place to go for some of that information, and they all have support teams as well that are able to answer those questions. So always a great resource there. A few questions quickly on Superhero, one from Sam on our FX fee. So our FX fee is 0.5% of whatever you're transferring. So we do charge that small fee. There is a cost to transferring between Aussie and US dollars, but then there's zero brokerage when you move across to trade. And there is no additional fee for express funding or anything like that. So it's just that one fee that you pay on transfer. And the process for selling US stocks and ETFs, Jerome, hopefully I explained that one for you. If you do want to know more, we also have a webinar on our YouTube channel that explains a bit more about how to actually trade US stocks with Superhero. And you can always ask our team on live chat as well, and they'll be able to help you out. One for you, Danny, physical gold and other commodities. There are gold ETFs out there as well. Do you have any kind of insight into that space? I know we're here talking more about US stocks, but particularly when it comes to, and I guess this is a question around inflation, and if interest rates do rise, what effect might that have on the stock market versus physical gold or some other commodities?
Yeah, so the first thing is, no, not at all. If we go into a 1970s scenario, okay, which is obviously the talk of the town at the moment, there's a lot of people pushing that. There's a lot of people that don't think that's going to be the case. Okay, but let's say we take the worst case scenario. The best class of asset to have if inflation goes up to ridiculous levels is cash. Bottom line, you put your cash like my mother did in the overnight account. Gold works in certain situations, but to give you an example, it kind of works when markets get the jitters, it works, but when there is a total drawdown, okay? And that goes back to the chart about the significance of the financialization of the world, how many financial assets there are. If you get a big drawdown, usually the drawdown occurs across all asset classes. And you will find gold ETFs will go, bond ETFs will go, shares will go, the whole lot goes. And that's why you saw the central bank, the Federal Reserve, intervening last March, because the market had become dysfunctional. Yes, it is a problem, but we are all caught in this kind of nexus of like, there's no point in just leaving. I'm not telling everyone to go and buy shares, but the point is that if you leave your money on cash in the bank, your purchasing power is going to go backwards too. And the thing about inflation is that people are now worried about a lot of inflation, but inflation is actually really positive for shares. 2 to 3% inflation, which is what the central banks want, is very positive. Deflation, disinflation is actually not good for shares either, and it's not good for anything. So my view on inflation is that it probably is potentially transitory. It is a risk, but I think the bigger risk that the central bankers are worried about at the moment is growth, because I think growth is being heavily challenged by the pandemic. And I know everybody wants the world to go back to 2019, but Boeing has just come out and said international aviation is not going to return for another 2.5 years. So again, it goes back to the technology paradigm. I think gold, your best bet is if you just actually physically want to hold gold, but that is very expensive. It costs you 2% just to physically hold some gold. And I was listening to an expert on this. We actually, gold is incredibly heavy. So there's something like only 5 Olympic-sized swimming pools of gold actually in the world, which is quite staggering. It's not that much. And they don't produce that much. And that's why people, kind of attach themselves to it. It's like this scarce resource. But I don't know. I think if you're young, that probably is not the way to go. But if you are concerned about the markets, you just sit back and you wait. You either wait for the drawdown, which may come at some stage, or you drip feed your money in. But just bear in mind, gold ETFs will sell off along with everything else if markets fall.
Great, thank you for that. And before we wrap up, I can just see from Chris there in the chat that you don't need to transfer from Aussie dollars to US dollars to buy ETFs. So correct, if you want to buy, an example of an ETF that has exposure to the US market is the BetaShares NASDAQ 100 ETF, or you might see on Superhero the theme US tech giants. That is an ETF, so it's listed on the ASX, so it's listed on the Australian share market, but gives you access, or the underlying holdings of that ETF are listed in the US market. So that's a way to get access to US companies without having to transfer to US dollars. Where you need to transfer to US dollars is if you want to invest in individual US companies, and you'll see that on Superhero using the US flag. You'll see a US flag, and that means that the share is listed in the US, the company is listed in the US, and there also are ETFs that are listed in the US, particularly around some of those trends, Danny, that we mentioned, like electric vehicles. Australia has a large range of ETFs now and growing, but I think the US is probably a little bit ahead of us in terms of particularly trend-based ETFs. As opposed to following a whole market or just the top 200 companies. The US listed ETF space also has a lot when it comes to particular trends that are appearing.
Absolutely. And there's also, everyone's probably heard of Cathie Wood from ARK Invest. Cathie started this trend of actively managed ETFs, which is basically stock picking in an ETF structure. And there is now an emerging number of those coming to market. One of the gentlemen who wrote the review for the book is a guy called Ross Gerber from Gerber Kawasaki. And that is a wealth manager out of the West Coast. And he has recently launched an active ETF called Gerber Kawasaki, ticker code GK. No, I'm not promoting it. I'm not being paid, but I'm just saying he does thematics like Cathie Wood in his ETF. So he has 9 themes. that he thinks will grow over time, and that's what he invests in. I think you're going to see more of those active ETFs actually coming to market.
Yeah, great. Thank you so much for that, Danny. So I think we'll leave it there. We're nearly at 1:30. Thank you so much, Danny, for joining us and taking us through everything when it comes to US investing. I certainly got a lot out of it, and I think our audience definitely did too. We will send around a recording of this webinar for anyone that wasn't able to join for the full time. And thank you so much to all of you for joining us today as well. And enjoy the rest of your day.
Thank you.